Okay, good evening, everyone. Can anyone confirm that you can hear me clearly before I proceed?
We can
I
hear
can
you,
hear you,
sir.
sir.
Nice. You're welcome again to another class. Tonight, we're going to continue from group account, from where we stopped on group account. And we have already established the, the background to group account. And the background comes from the fact that there are intercorporate investment companies investing in another, and this investment can result into investment in subsidiary, investment in associate, and financial asset. We said our focus here is investment in subsidiary and investment in associate, and we started out with investment in associate. Sorry, investment in subsidiary. And we mentioned that investment in subsidiary will arise when you acquire equity interest in another entity and your holding in that entity is above 50%. And when you have that, it gives you control. We explain what control is, and we saw that one of the key elements of control is power. And this power can either arise directly from holding majority voting rights or indirectly by having the ability to appoint and remove key people within the entity. We then proceeded into, okay, when you have a subsidiary, how do you account for such a subsidiary in your books? We said, okay, two things, right? IS 27 says you need to prepare your own account, your own separate account. And in your own separate account, you need to show that investment in subsidiary in your books. IFRS 10 says, okay, fine. In addition to that, you are required to prepare consolidated financial statement using what we call a consolidation method. And this consolidation method requires that you are going to just cancel out similar transactions that occur between the parent and the subsidiary. If it has more than one subsidiary, subsidiaries, any similar transactions that occur between them should be cancelled out. And any item that are uncancelled, just add them together. That was all, that is all we're going to do. And basically, the only transactions we have been canceling out all along majorly is just between investment in the books of the parents and also the equity acquired, which is represented by the net asset acquired in the books of the subsidiary. We cancel that out. And in doing that cancellation, a lot of things has actually come up. A lot of things like when the parent does not acquire the whole of the 100%, okay, so that means you are going to cancel out to the extent of some whatever interest he has acquired. That's the cancellation. And whatever is remaining uncancelled, we call it non-controlling interest. And you see that the model we adopted in doing our cancellation was we have the consideration transferred, we add NCI, and then we net that off against the net asset acquired. Then whatever is remaining is either goodwill or gain on bargain purchase. It's mostly going to be goodwill in the exam because gain on bargain purchase is unlikely because it means that the amount that has been paid, the fair value paid for the fair value of the net asset of the subsidiary is lower than the net asset. It's rare. And that is why IFRS 10 says that when you get a gain on bargain purchase, when you see that the amount paid is lower than the net asset acquired, you say you need to do three things. Number one, check how much you paid. Check that you have captured how much you paid very well. Number two, you say check how you measure the NCI. Check it. Did you measure NCI properly? Number three, it says that go and check how you have measured the net asset acquired. Did you measure? I mean, it's asking you to recalculate and recheck your figures because we don't expect to see such, right? So In most questions, you find out you're going to have goodwill. But if it happens that you have gain or bargain purchase, fine, it's going to be a gain to the parent that will be added to the account of the parent. And a lot of things are now coming up as a result of that cancellation, also as a result of the NCI as well. Now, NCI, you now said, okay, two ways of measuring it. Is either you're measuring it at proportionate share of subsidiaries net asset, which is also called partial goodwill method. And you could also measure it at full fair value, which is also called full goodwill method. See, when you measure NCI proportionate share, whatever goodwill you get solely belongs to the parents. Because like for NCI, that model we use is in and out. It cancels out completely the NCI portion. So whatever balance you're having is coming as a result of the excess the parent must have paid over his own holding in the subsidiary. But where the NCI is measured at proportionate share, and that is when you'll be having a balance. That's where the NCI also is now contributing to whatever goodwill you're getting, and is also going to have a share of that goodwill. And you also see the impact when you now have. So you see, at the level of goodwill, no issue. It doesn't affect our calculation, whether you measure NCI at proportionate share or at full fair value. Whatever goodwill you get, you just put it under non-current asset. However, if there is now impairment of goodwill, we saw it last week, impairment of goodwill arising where NCI is measured at proportionate share, that impairment of goodwill will solely impact the P&L of the parent. That's why we only remove it from the retained earnings of the parent, because the goodwill solely belongs to the parent. So the impairment of goodwill, we deduct it from, it's like an expense to the parent. But where NCI is measured at proportionate share, then the impairment you now get, it belongs to NCI and parent. So to effect that, we usually effect it in the P&L of the subsidiary. So it will affect the P&L of the subsidiary, the retained earnings of the subsidiary in such a way that whatever is remaining they are sharing will now be reduced. Then they then get to share. So we have looked at series of dynamics. It's a very simple area of the syllabus. Just need to practice all of these things yourself, and you would confirm that it's actually very straightforward. So today we are going to solve more questions, continue on the same line, and see where that takes us today. Okay, now for today, we're starting with question 12. And this question says that Pico acquired 75% of the ordinary shares of ESCO on 1st January 2017 when ESCO had retained earnings of 75. On that date, Pico made a cash payment of 34,000 and a further payment of 10,000 in the next 2 years. If ESCO post-acquisition profit have exceeded an agreed figure by that date, NCI is measured at proportionate share of subsidiaries net asset. So statement of financial position of the two was given. So you're now required to prepare consolidated statement of financial position of PICO at 34th December 2017. The parent cost of capital is 10%. Okay. So for this question, they want us to consolidate. Again, cancellation. We're going to cancel out investment in subsidiary against the equity of the subsidiary. Or however, I can see here that the parent paid 34,000, which is this 34,000 cash that he has recorded in his books. But they say he's going to pay further 10,000 in the future if ESCO post-acquisition profit have exceeded an agreed figure. Okay. How is this? I've taught you this before. This 10,000, how will it be treated and which standard deals with this? How are we going to put this in our books? Is there anybody that can speak to this in this class? This 10,000, how will it be treated in the books?
We will discount it.
We're going to discount it. That's correct. We're going to discount it. Fine. Because it's an amount that will be paid in the future, but that is not what I want to hear. So what I'm saying is that what item is it? Is it an expense? Is it a liability? Is it an income? Is it an asset? Is it a provision? That's what I'm asking. What class of item is it in our books? Is there anyone that can really speak to that here? You should be able to.
Um, huh? But when I say it's a contract liability.
No, you cannot say it is a contra liability because contra liability is when you have collected money and you have not offered this
Mm,
service. That's different from there. That's IFRS 15. Who's going to speak to this?
oh,
Is it a financial liability?
So a financial liability is a contractual obligation to deliver cash, right?
Yes, yes, sir.
Yeah. So this one is not, there is no present obligation yet here. Even though there is a present obligation, um, the guy has not really made that profit yet. He has not really, so we cannot, it looks like a financial liability you have tried, but the fact that it's not a lab, is not, I mean, we cannot classify as a financial liability yet because it has not even gotten to that level. So you have tried them. So it's two things. It's a contingent liability under IS 37 because he said, I will pay you 10,000 on December 2018 if ESCO post-acquisition profit have exceeded an agreed amount. So if you look at the way I define ordinarily, is either provision or contingent liability. But it cannot make provision yet because it is not probable. Though there is a present obligation because he has entered into an agreement, so there's an obligation. But it is not probable that there will be an outflow of resources because the guy have not exceeded the agreed figure. As soon as he exceed, then you need to provide for it, right? So this is a contingent consideration according to IS 37. It's because the contingent liability. Now, how do we treat contingent liability? If you remember, under IS 37, I told you that contingent liability are not recognized in the books. What we do to them is that we disclose them. We only disclose them in the books, according to IS 37. Mm. IFRS 10 takes exemption to that. IFRS 10 takes exemption to that. IFRS 10 is allowed to recognize contingent consideration or contingent liability in the consolidated account. Because as far as the group is concerned, because it's a transaction between the parent and the subsidiary. As far as they are concerned, the group has a liability because one person is between them. So they know that this person will pay. They can estimate the amount reliably. They know that it will make the profit. It will make the profit. So IFRS 10 allows that, okay, recognize contingent consideration in the books. So when we recognize contingent liability, you need to question it first because IS 37 says do not recognize it in the books, but disclose, tell us about it in a note. But here we are going to recognize it in the books. And that's the only thing that's special here. That's the only thing that's special here. So let's just do our cancellation. In doing cancellation, it usually results in goodwill. Yeah, we'll have our consideration transferred. How much did he pay? 34,000. But now this consideration transfer is in two phase cash, Abi. It's paying cash of 34 and it promised to pay a further 10,000 in how many years' time? This is 1st of January. That's in 2 years. Yeah, 17, 18. That's in 2 years' time. So that will be 10,000 to bracket 1 point. What's the cost of capital? That's why they gave us this 10%. That's 1.1 raised to power minus 2. What would that give us? Anyone?
0.8264. Okay, multiply by 1,000.
Yeah.
8,264.
8,264.
8264. Now, then we can then consider NCI. NCI, is it proportionate share or yeah, it's proportionate share. So let's determine the net asset acquired, then we come back to that. Now, the net asset acquired at the date of acquisition comprises ordinary share capital. What was the ordinary shares of the subsidiary? We acquired 25,000. 25,000. What was the pre-acquisition retained earnings?
75.
The subsidiary 75. So that is what we acquired. So addition of the two gives us
32,500.
100. So now, since this is proportionate share, what's the holding of the NCI? That's 25%, right?
Yes.
25% times what? 32.5. What does that give us?
And 8,125.
8125. So what's the addition of these three?
Um, 55, 50,389.
50,000.
389.
Sorry, good evening, Mr. Washi. I want to ask a question. Why did you
Okay.
times the contingent consideration time raised to power 2?
Okay. Because we are paying back on 31st December 2018. And the date of acquisition was 1st of January 2017. So that's in the next 2 years. So 17, 18. Is that clear?
Yes, it is. Thank you very much.
Okay, all right. Okay. So what's our goodwill?
17,889.
17,889. Okay, so having determined that as our workings one, then we can determine our workings two. Let me do that contingent consideration. Because of the question she asked, so you see, at acquisition date, how much was the contingent consideration? It was from workings one, it was 8264. 8264. So there will be unwinding of discount at the year end. Unwinding of discounts through finance costs at year end. So at year end, we are going to unwind discount. You should be used to this. Those that I taught you provisions. So you know that anytime you discount to present value, at the end of the year, you have to unwind the discount because so that the figure would increase back towards that future amount. So at the end of the year, which is December, so we need to do, what's the cost of capital? We need to do 10% times the opening value, which is 8264. And that gives us, let me just approximate, 826. 826. So at the end of the year, the value will have gone up to how much? Can you help?
1990.
9090. Okay. Now, don't forget that this amount will go to where? Will go to PL. While this one will be like a current liability at the end of the year. It's a current liability because it's due next year. If it was due in like 2019, for example, now, maybe it would be non-current. But in this case, it's due next year, so it's current. So we'll do our consolidated retained earnings. We'll have PICO and ESCO. As per the correction first, what was the retained earnings of this 35, this 12.5? So 35, 12.5. You deduct pre-acquisition retained earnings that we have cancelled out, which is 7.5, just so that we are left with the post that will now be shared between the two. So this balance is the post-acquisition retained earnings, which is 5,000. Now, that finance cost that we promised to pay, that we used to unwind the discounts as arising from that contingent consideration in the books of the parents, it will reduce it will be expense to P&L of the parent, so it will impact retained earnings here. It's going to impact retained earnings here. So now let's now get share of ESCO retained earnings, which is 75% times 5,000, which is 3,000 watts, 750. Please confirm that I'm correct. So what's the addition? This minus this plus this.
That's 37,924.
37,924. Then my non-controlling interest. So based on the setup I've done up here, I've already established the value of my NCI to be 8125. And it's also going to get a share of ESCO post-acquisition retained earnings, which is simply 25% times 5,000, which is how much? 1,250. And how much is the total? It is 937. Okay. So PICO, consolidated statement of financial position as at year ended 31st December 2000 and what? 17. Assets, non-current assets. Now, the first item here is PP. And if I add these two together, it gives me 55,000. The second item is investments, and this has been cancelled out against equity, giving us a balance of goodwill of 17,889. So we have goodwill 17,889. Then the next item is current assets. Can you please add 26,000 plus 17,500?
43,500.
43,500. Okay, so let's add these three together. What's our total asset?
116,389.
116,389.
Okay, thank you. Equity and liabilities. Equity, ordinary share capital. By now, you should be used to the fact that the ordinary share capital will be that of the parent alone because this of the subsidiary has been cancelled out. Whatever balance that is remaining is now known as NCI, no longer equity or ordinary shares. So the ordinary shares we consolidate is only that of the parent, which is 50,000. Then consolidated within earnings, which is my working stream. And from this working street, it was 27,924. 27,924. Then the next item will be non-controlling interest, which is working for. And from working for, it was 9,375 here. This is 9,375. Then can you please add this? Let's get our total equity. Let's get our total equity.
Ninety-seven to 99.
997,299.
Okay. I was faster than your calculator. Then we can then consolidate the current liabilities. How much is the current liabilities? 10,000. So there's something you might forget, which is this guy. Where is it? This contingent consideration. You might forget it to put it under your current liabilities. Please don't forget it. Please don't forget it. Contingent liability or consideration. 9090. So what do you have as balance?
One one six
One
three eight nine.
six one one 16389.
Now, see, the only new thing here, and there is nothing new here that I haven't taught you before. The consolation principle still remains. You should already be used to that. So the only thing I introduce is the fact that there is a contingent consideration that we need to discount to present value. And this contingent consideration, I have to ensure that I unwind the discount at the end of the year because this amount here is calculated at the date of acquisition. So we need to unwind the discount at the end of the year by applying the discount rate on the opening balance. And that discount, that unwinding of discount, which is a finance cost, would be going to POL, which ultimately impacted the retained earnings of the parent. And we did not also forget to add the contingent consideration as part of our current liabilities. And that's really it for that particular one. So,
So I would like to ask,
okay, just hold on,
okay,
sorry.
sir.
So in the exam, they could call it contingent consideration, they could call it deferred consideration, whatever, the treatment is the same. The difference is that contingent is dependent on, they will give a condition, but deferred, that one, there's no condition attached. It's just, it's just an amount that is payable in the future. So, but the treatment is the same for the two of them. Okay, Femi, please ask your question.
Okay, sir. Two things, sir. Now,
Okay.
in this scenario that we just treated now, suppose we're asked to maybe the NCI should be, we should use fair value for NCI. Is there going to be different in the way we are going to look at the retained earning? Or is it going to still affect only the parent? That's number one. Number two, what of if this current liability that we calculated, the unwinding, I mean the deferred payment, suppose it's going to be like for 3 years. Now you said this one is not going to, there is going to be non-current liability and current liability. Are we going to split it? That's what I just wanted to know. Like maybe if it is 3 years, how is it going to be treated?
All right, so good question. Um, so first, your first question, I'm sure you are referring to this finance costs that you said that if NCI was measured at fair value, would these finance costs here that we remove from parents alone, would it have been removed from,
Yes.
right? No, 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 it won't. This is a liability of the parents. Is the parent that promised to pay. So however you measure NCI has no business with that. So the finance cost is an expense of the parent. And secondly, don't separate in the exam for a question like this. Don't bother yourself separating the contingent into current, non-current. Yeah, you're thinking right because you're applying what I've taught you guys in the past. So if it was payment made in the next 3 years, this will have been three. So that means whatever it is you have, we can separate it. There is a portion that we are paying next year, and there's a portion that we are paying next 2 years. In a structure of a question like this, don't bother doing that separation. It's not worth it. You'll be wasting time and you might make mistakes. So don't do that. So it's only applied in a question like the one I gave you that we did, the example we did on the provisions where we did year one, year two, year three. That one, it is clear. We can see it clearly that, okay, this is the amount we are paying next year. This is the amount we are paying in the next 2 years. That's the only situation where you do that breakdown. Additionally, under lease liability, when you're doing lease liability, we usually construct those liability for all the years. So that one too, you can easily do that separation. So it is when a question is set up or solution is set up in such a manner that you can clearly see how much is paid next year, how much is paid payable in the next year, that you have done the schedule that shows it clearly. You are expected to do that separation in your solution, but not something like this. Don't bother. Don't do it. And not only that, not only that, for this contingent consideration, you don't even do it, not only because of the explanation I've given, but for the fact that you are not paying any amount next year. You are not paying anything next year. It's something you're paying in the next 2 years. If this was three, for example, at the end of the year, it's like you are paying it. So there's no element of it that is current as far as contingent consideration is concerned. So you can only do separation where you can see that okay, you are paying something next year. You are paying something in the next, but this one is a one-off payment in the future. So I'm paying you 10,000 in the next 3 years. So there is no current, except when it is now remaining 1 year. Then that non-current becomes current, like in this question now. As at the end of 2017, it's now current because I'm paying it next year. Right? So if it had been next 3 years, we will have treated everything as non-current. I hope that answered your question. Okay, let's go to Latif. I can see your hands up, please. Go ahead.
Yes, sir. Thank you, sir. The question as per this one really specified that the contingent consideration will be paid if certain conditions is met. Right?
Okay.
So if
Yeah.
in a question and it states that that condition is not met, then what should we do?
Okay. So if they say the condition is not met, um, so that means there is no, that means don't treat it, That means ignore it. That means there is no present obligation anymore, right? So you definitely are going to ignore it. But they won't give you that kind of question in the exam because they wouldn't know whether it will be met or not until that future date. They can't know now. So, and they won't possibly give you one that it is that date when it is now due for payment. They now say it was not met. It doesn't have any accounting consequence at that date. So a question will not be set up in that manner where they tell you that we want to pay in the next 2 years and it did not meet. How did they know? They can't know now until that future date. That's when they will know. So yeah, but if for whatever reason, if that happens, that means there is no liability anymore, you ignore. But they won't set up the question in that manner.
Good, sir.
Yeah. Further questions? You guys are impressing me with all these your questions, so that's nice. It seems you people like group accounts. When we're doing standard, everybody be quiet. Any question, nobody will talk. Is it that you don't understand those ones? It's okay. Can we move on, please? Do you have permission to move on, Mr. Femi? You're the one I actually communicate to more in this class.
Yes, sir. You want me to read?
Let me read. Yeah, you can read. I'm tired.
PICO acquires 75% of the ordinary share of ESCO by issuing five of its own ₦1 share for every 3 shares in ESCO on 1st of January 2017, when ESCO had retained any of 7,500 naira. The market value of the parent company's share is 5 naira. NCI is measured at proportionate share of subsidiaries' net assets. statement of financial position as at 31st December 2017 is as follows.
Okay, thank you. That's
You are
all.
then required.
So consolidate. Okay. So what is new here now? Okay. What is new here is just the way he's paying now. He's not paying cash. He wants to issue shares. So he bought this guy. He now says he's going to pay by issuing shares of 5 of his own 1 naira shares for every 3 shares in ESCO and these dates. I think every other thing remain the same. And they gave us, okay, since you are issuing your shares, that means they gave us the market value of the parent shares. That, okay, for example, if I'm giving you 10 shares, that means multiply that 10 by 5 naira. That's the equivalent consideration. That's as good as 50 naira, something like that. Okay, so that means we need to compute that contingent consideration ourselves. Very straightforward. So I think that's the only thing here. The cancellation then, because since it's not paying, so they haven't even recognized the investment. You see that there's no investment in subsidiary in the books at all. So that means we need to incorporate it first. We need to incorporate it first. So let me start with that workings. Let me start with calculating the consideration transferred, which is through share exchange. And the calculation is the parent is going to give the shares. Let's calculate the number of shares issued. It's going to give how many shares?
Five
To
for
issue?
3.
Yeah, 5 for every 3 acquired. So 5 over 3 multiplied by how many shares is he acquiring in ESCO? ESCO has 25,000 shares. Yeah, this is how I know. 25,000 shares. You know that if the examiner gives you this 1 naira as 50 kobo, that means this becomes 50,000 shares. Because that's like 50,000 times 0.5 is what will give you 25,000. But they gave us this as 1 naira, so fine. Everything is still easy. So I'm giving him 5 shares for every 3 shares in ESCO. So if you just do it times 25,000, you are wrong. So it has to be for every shares I bought in ESCO. So this is a typical mistake you make in the exam because of the way they set up the question for you. They said 5 of my own shares for every 3 in ESCO. So some people will interpret it as okay, 5 over 3 times the whole of the shares. No, now. How can you cannot be on the whole of the shares. It's on what I've acquired. Because what's my business with the other ones? Why am I giving him shares for every of his shares? It's for everyone I have acquired in him. So please, 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 don't forget. So how much are we looking at? No, not how much. What's the number of shares we're looking at?
31,250.
So 31,250 shares. So what's the value of the shares I'm giving him then? That's 31,250 shares times how much is that? That's 5 naira. 5 naira. So what are we looking at?
156,250 naira.
Okay, that's the consideration transferred. Okay, having determined that, now I can do my cancellation, which is my goodwill. start with my consideration transferred, which is 156 to 50. I do my non-controlling interest. How is the non-controlling interest measured? Proportionate share. Okay. Since it's proportionate share, let me get my net assets acquired in the subsidiary, which is the ordinary shares of the subsidiary. What's the ordinary share capital of the subsidiary? It's 25. Then the pre-acquisition retained earnings of the subsidiary, 75 here. This is 75. 75. Then the total gives us 32,500. Then proportionate share, that's 25% times 32,500. How much is that?
8125.
Sorry? 8125.
8125.
Okay. 8125. So how much is this?
One six four three seven five.
164375.
164375.
So what's my goodwill?
One three
One
one eight
three
seven five.
one 875.
This is the biggest goodwill ever. So it's a good deal. So consolidated retained earnings. Per question. Also retained earnings of the parents, 32,525. You remove pre-acquisition retained earnings, which is 75. I'm left with the posts, which is 5,000. So share of ESCO retained earnings, which is 75% times 5,000, which is 3,000 something.
Share of Pico.
Sorry?
Pico.
Sorry? I don't.
Year of ESCO. Year of ESCO.
Okay, so how much are we looking at? It's 36, 250. Is that correct?
Yes, sir.
Now, my NCI, the value of NCI setup up there was 8125. Share of ESCO retained earnings, which is 25% times 1 to 50.
Now, where you wrote share of ESCO retaining in the 75%, you're supposed to put share of Pico.
That's what I was saying.
That share of the first one, the 75% of 5,000 naira.
How will I put share of PICO? Is the parent share in ESCO's retained earnings? Have I been writing
Okay.
PICO since? I've been writing ESCO now. ESCO. ESCO. So this ESCO, not PICO. Is my share in ESCO's retained earnings, which is these ESCO's retained earnings. So this is 9375. Okay. You know what? I think it's the same question. So same question. Now in this case, my goodwill is a lot of money. I'm rich. Yeah. I'm sure nothing has changed. So can you help me add 55 plus 131 plus 43, 500? Anyone?
That should be 230,375. Abi? Mm-hmm. 55, yes, 230,375.
Okay. So my consolidated within earnings is 36 to 50. 36 to 50. My NCI is NCI is 9375. Okay, it hasn't changed. My current liabilities hasn't changed. We don't have this in this case. Now, there's something that we have not treated, which is the share capital of the parents, which is this 50,000. You know that the parents issued shares. He issued shares, share issue. He has issued share of 31,250. So you know that yes, he will debit investment and subsidiary, which is the 156,250. Do you know why we credit share capital? But when it's crediting share capital, it doesn't credit share capital the whole of the with the whole of the 5 naira. It credits share capital with nominal value, which is 1 naira, which is let me confirm, which is 1 naira. Okay, this is 1 naira. Yeah, that's the nominal value. So this remains 31,250. The balance of 4 naira. Well, where are we going to credit? With the balance.
Yeah, premium.
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 Thank you. Premium times 4 naira. So how much is that?
125,000.
125,000. So that means now this one would be 50,000 plus 31,250, which is 81,250. And also we're going to have share premium, which is how much? 125,000. 125,000. So can you help me add this together? What does it come to? What does this come to?
261,875. Oh,
261,875. And
1,000.
what's my
Sorry.
current liabilities?
25.
I think it's 251, 250.
It's
It's
251, sorry.
It's 251.
I added the 10,000 already.
So this will give me how much?
Yeah.
261,875.
251,
875.
250. Oh, sorry.
875.
875. So what did we omit from here?
What of this 50,000 investment in ESCO
Okay.
in the beginning?
No. There's nothing wrong. We are using the wrong figures. I copy and pasted that
Oh,
other.
okay.
Okay. So can you add this one? What does this give us? 64 plus 25. That's 89, Abi.
yes. Yes, sir, 89.
This is 89,000. What about the current assets? When you're rushing, you just be doing nonsense. So this should be the same now,
The
43,500.
same thing. Yes.
And these other one are the same, 35, 35, yeah. No, this one. This 32,000 is not, they have changed it to 35 in this correction. So that means this will change to 38,750. This 38,750. 38,750. Yeah, let me see. Can you give me a new figure here?
259,625.
2,
59625.
625. Can you give me the figure here?
264,375.
264. And this gives us 274. Oh,
This one is 264,375. This assets, current asset, the addition of this is 264,375.
254,375.
It's 264.
This one. The equity and liability.
The
The
non-current
asset
asset
first
and
is 264,375.
yes, 264,375.
264,375, sir.
But
yeah. How about this?
This one is 254,375. 254,375. Yes, but that one is
All
wrong.
right, thank you. Okay, so here now, the only thing that is different from what we have been doing so far is just the fact that, and you have to be very careful here, is the fact that the consideration was through shares, through share exchange. So we carefully computed the number of shares. The examiner gave us the share price of the parent, since it's the one issuing the shares, so we were able to get the value of those shares. Then, since it has not been recorded in his book, so we figured that, okay, that will be investment in subsidiary, this amount, and the amount that goes to share capital will be at nominal value. and the excess goes to share premium. And when we're consolidating, we properly added the one that go to share capital to the share capital of the parent, and the one that goes to share premium, we presented it separately in the books. And that's just the new thing for this question. Okay, now let's solve another question. Now, for this other one, they give us a statement of financial position of PICO and ESCO as at this date. Yeah, a lot of items. So, and I was told that PICO acquired ESCO on 1st January 2017 when the retained earnings stood at 3,000. The agreed consideration is 15 and a further 5,000 on 31st December 2018. PICO cost of capital is 8%. ESCO has an internally developed brand name, which was valued at 25. At the date of acquisition, there have been no changes in share capital or evaluation surplus of ESCO since that date. At 31st December 2017, ESCO had invoiced PICO for goods to the value of 1,000, and PICO had sent payment in full, but this has not been received by ESCO. It's the group's policy to value NCR at full fair value. At the acquisition date, NCR was valued at 9,000 required. Okay, good question. So this one encompassed a lot of things I've taught you in one question. Fine, let's resolve it. So, a few things we need to quickly resolve here. The first one is, this one is normal. This first sentence, okay, we acquired them in January and the retained earnings of ESCO is this. That means this is the pre-acquisition retained earnings. So that means out of this 14,000, 3,000 is pre. That means 11,000 is post. That one is no issue with that. Secondly, the
Sorry, can I send you?
Secondly, the agreed consideration was 15,000 cash and a further 5,000 to be paid in 2018. Similar to what we have done before. You see that the consideration written here is just the 15,000, which was paid in cash. The additional that will be paid in 2018 is a deferred consideration, so which we're going to discount to present value. So and they're paying it in the next 2 years, because the date of acquisition is 1st January 2017 and we are paying on 31st December 2018. That's in 2 years' time, 17, 18. So we discount using 2 years. And they gave us this cost of capital of 8%. Now, there's something we haven't seen before. They said the subsidiary has an internally developed brand name of 25 at the date of acquisition. Okay, we haven't seen this one before, right? So, can I joggle your mind a little bit? What do we do with this? Is there anyone that can speak to this? That's okay. Because if I look at the book of the subsidiary, it's not there. It's not there. I can't see any brand name. But ESCO has an internally developed brand name. So I think the first question I should ask you, why is this 25 not in the books of ESCO? Why is it not there? Is there anybody that can speak to that in this class?
It's internally developed, what do I call it now? It's internally developed goodwill, so they will not recognize it in their book
Why?
because it's internally developed.
So which standard says you should not do that?
Is it-
Is there anybody in this class that can speak to that? Which standard? Yeah.
Goodwill, that is
It's not even goodwill. I don't know why you're mentioning goodwill. They say brand name. You're saying goodwill.
I think you have taught us something like this under goodwill.
I didn't touch you anything like this under good. I actually taught you under yesterday under when you're determining the value of an intangible asset, when you want to recognize it. When you have internally generated intangible assets, they are not recognized in the books because they cannot be measured reliably. However, on consolidation, we will be able to determine the amount because somebody is there to pay for it. Somebody is there to pay for it. I'm not happy that you can't remember. I'm not impressed at all. That's the downside of just teaching, and people are not reading. It's just a waste of time. And that's why people fail exams, because if you don't read, you definitely fail. Um, just hold on. So what I'm sharing here is the working note on IES 38. Okay, if you look at this year, I said internally generated intangible asset. It is not recognized in the financial statements because we cannot reliably measure the benefits derived from the asset, and the cost incurred to get the assets cannot be measured reliably. Examples are goodwill and brand name. And I've said, however, in the consolidated financial statements, these internally generated intangible assets are usually recognized because it is deemed that the parent acquired these assets. So they are seen as purchased intangible assets, and we can reliably determine their cost. I'm not reading. Somebody will just be writing everything. I don't know who you are keeping it for. Anyway, let me continue to do what I know how to do best. Teach you. You like doing it. So ESCO has an internally developed brand name, which was valued at 2.5. Now, this 2.5 is not in the books of ESCO separate accounts because it cannot be there according to IS 38. It is an internally generated intangible asset. You cannot measure it. However, now that somebody has come to buy him, the guy can place a value on it, and the parent has placed a value of 2.5 on it. So now we will now introduce it in the books. And the way we introduce it in the books is we're going to debit in the books of the subsidiary, the way we record it, the subsidiary will debit reserve and credit intangible assets. You would debit reserve and credit. So you are the one that will do it in the exam at the date of acquisition. Debit reserve, credit intangible asset. Because why I'm debiting reserve? Because it's like a revaluation surplus. It's like an increase in value that was not in the books of ESCO before. Now we are introducing it in the books of ESCO. So it's like a surplus. Debit reserve, then you credit you credit reserve, you debit intangible asset. That's how you record this. That's how you record this. Now, if you understand that, then you also need to understand the fact that this reserve, because it's a surplus, it's a fair value surplus. I'm recognizing this surplus at the date of acquisition. So it's part of what the parent is then acquiring, obviously. So it's part of what you're going to cancel out on consolidation. Okay. Also, in this next paragraph, they say there have been no changes in the share capital or evaluation surplus of ESCO since that date. There have been no changes in share capital or evaluation surplus. Okay, so they are saying that this share capital and evaluation surplus of the subsidiary, there is no changes in it since the date of acquisition. meaning that this evaluation surplus is pre. It was there at the date of acquisition. It's a pre-acquisition surplus. So it has to be cancelled out as well because they said it has not changed since that date. Also, they said ESCO invoice goods to add ESCO had invoiced Pico goods at a value of 1,000 and Pico had sent payment in full but has not been received by ESCO. Okay, so that means there's a cash in transit. So let me see if it's in the account. Okay, owed by Pico, 5,000. Owed to ESCO, 4,000. Okay, good. That means the difference of 1,000 is that cash in transit. That's what they're explaining with this. That's what they're explaining with this. So owed by Pico. So Pico is saying, okay, ESCO is saying you're owing me 5,000. This one is saying, oh, I've sent you money now. I'm only owing you 4,000 now. And it's because this guy hasn't received it. So there's a 1,000 uncompleted transaction that cannot be eliminated. So when you're eliminating, you eliminate to the tune of the 4,000 that has been completed. The remaining 1,000 will be consolidated because, yeah, it's a similar transaction, but not completed yet. So you still put it in the books, still pending. Okay. So the value NCI at, okay. So now let's get to it. First, I need to resolve this contingent consideration, this consideration transferred. Let me use that as my workings one. So consideration transferred. There is cash payment of I think 34,000. No, 15. And there is a deferred consideration of how much? 5,000, which I would 1.08 because they gave me the cost of capital as 8%. And I'm paying in the next 2 years because this is 1st of January 2014, so 17, 18. That's in the next 2 years, raised to power minus 2. So what does that give us?
Five, eight, three, four.
4,286 naira. 4,286 naira.
Okay,
Like, what's the calculation?
so how much is the total? 19,286. Then the second one, before I do cancellation, let me recognize this internally generated brand name. So we'll debit, let me call it fair value surplus. Is a pre-acquisition because I'm doing the valuation at the date of acquisition. Am I debiting it? Credits. And I would debit intangible assets. Debit intangible assets, which is the brand name. Also 25. Okay. Is it okay? I can see your hand raised. Go ahead, please.
Okay. Um, My question is just the 1.08. I'm just trying to figure how we got it. That's just. I
Okay.
think it should be 8%, which is 0.08. So do we add any 1 plus 0.08?
Know that the formula is 1 plus r raised to power minus 2. So 1 plus r is like 1 plus 0.08. That's 1.08. That's how we got this.
All right, thank you.
Okay. So we have resolved this as well. And there's no other workings again. So I can do my cancellation, which is my goodwill. So my consideration transferred, which is 19,286. I will add the non-controlling interest. They said it's measured at 9,000, so I will have 9,000. What's the addition of that? What does that give us? That's 28, 286.
Okay.
Net asset acquired, ordinary share capital. What's the ordinary share capital of the subsidiary? That's 12.5. Okay, 12.5. Then the pre-acquisition retained earnings. How much is that? That's 3,000. Then things you forget, you might forget in the exam. Number one is this workings that I set up. This fair value surplus for brand name. So this fair value surplus is a. So let me put brand name in brackets so that you know that it's arising from that brand name. It didn't just come there magically. Another one that you might forget is this one that they told me there have not been changes in share capital and evaluation surplus since that date. A lot of people will not know the relevance of that statement, that they are simply telling you that this reserve here is pre. It's actually pre because there has not been changes. It has just been there. So it has been there since acquisition. And since what the parent buys, what it pays for is equity or the net asset of the subsidiary, then it needs to be cancelled out. Two five. Oh, I wrote 2,000. This is 2.5 as well. Okay, so we are dealt with the entire reserves. So what does that give us? Please confirm that I'm correct.
Correct, sir.
Good. So what's the difference now? 28,286 minus 2.5.
7,786. 7,786.
Okay. Okay. Then the consolidated retained earnings. As per question, what was the retained earnings of the parents? 13,000. 13,000. Subsidiary was 14,000. We confirm. 14,000. Okay, good. Then You deduct pre-acquisition retained earnings, which was 3,000. That means the post-acquisition earnings is 11. So share in ESCO's post-retained earnings, that's 5% times 11,000. What does this give us?
8250.
8250. What was the total?
21,250.
Is it 21 or 22?
21,250, sir.
Okay. And finally, we have the non-controlling interest. Value of NCI. From what we set up, it was 9,000. Share in escrow retained earnings. So what's remaining? Confirm that this is correct.
2750.
Okay.
750, sir.
And this gives us 12,750, right?
11,750.
That 11,750.
Okay, this is 2,750.
Yes, sir.
Okay. Okay, let's do our consolidated statement of financial position as at year ended 31st December 2000 and I think 17. Yeah, 17. Okay. Assets, non-current assets. No rush, I won't make mistakes like earlier. So addition of these two will give me 45,000. All right. This 45,000. Then this one, and I canceled out, give me goodwill of 7786. Then, lest I forget my intangible assets, which is the brand name of 25. Don't forget this workings too. Debit this, credit this. So that's that debit there you're saying. Then I can move to current assets. So the first item there is inventory. If I add these two together, it gives me 5,000, 5,400. I have 5,400. Then okay, somebody is asking a reasonable question. How did you get this 75%? I use this 75% because we have been using 75% since in all our questions. So can anyone confirm what's the percentage holding? What percentage holding does the parent has in escrow? From what I'm showing you on the board here, what was the percentage holding of the parent?
80%, sir.
How did you get that?
That's 10,000 investment. That is shares 10,000. Then divide by the shares of 12,500 multiplied by 100.
Okay, that's correct. So I think that should be that 80. That means this is supposed to be 80% then. So that question as well, she asked us put us in the right direction. That should be 8,800. So where will I say that out? So let me say percentage acquired in Expo. That's 10,000 divided by 10,500. And that gives 80%. Okay. So that means this will be 20%. I guess this should be 2,200. So this will change to what? That will be 800 here. So it will be 21,800, right?
Yes, sir. Yes, sir.
And this will be how much? 11,200.
Yes, sir.
11,200.
11.
Okay, so that was a good question because it actually helped us. That means she's following very well. Okay. Then after inventory, the next one is this one, owned by Pico. So that means there will be a corresponding owed to ESCO. So we need to cancel out these two. And they have already told us that the reason why they are not the same is because of cash in transit. So this one is saying, you're owing me 5,000. No, this one is saying, no, I'm owing you 4,000. And the question already told us that the difference is because of this guy has sent money. He sent money, but he did not receive 1,000. So we need to consolidate that cash in transit of 1,000. Then now receivables consolidated. What's 8,000 plus 3,500? That's 11,500. Receivables. Then we have cash at bank, which is 1,000. 1,000. Okay, so let's get our total assets. So can you help me add 45,000 plus 7,786 plus 25 plus 54 plus 1,000 plus 1,000 plus 11,500. So my total assets
74,186.
74,186. So compare that to my equity and liabilities. Equity. Start with my ordinary share capital. What was the ordinary share capital? This. So this has been cancelled out. So we're only left to 22,500. Then the next evaluation surplus. This has been cancelled out. So we are left with this 6,000. Then these retained earnings, we already set up our workings for that here. And we are having 21,800 for consolidated retained earnings. So this is 21,800, right? Yeah. Then after that, the NCI can then come in, which is working 6, 11,200. So non-controlling interest, 11,200 comes in as 6. This comes in as working 5. This one comes in as, I think, working 2 or working 3. Right, these are comes in as working 2. Yeah, working no, working 3, working 4. Working 3, working 4. Yeah. Okay. So let's add these equity together. 22,500 plus 6,000 plus 21,800 plus 11.
61,500.
That's 61,500. Now we have our current liabilities. Raise our current liabilities. Made a mistake, sir. So O to ESCO will not come up, but since it has been cancelled out, but trade payables is now 85. Trade payables is 8,400, but something you might forget, which is that deferred consideration. So that you don't forget, like we forgot right now. So when you do this deferred consideration, when you do these workings, immediately, so since we forgot, so let's just come here and actually set it up. Deferred consideration at the end, because at acquisition, the PV of that deferred consideration was how much? 4,286. But at the end, we need to do unwinding of discounts. Unwinding of discounts to finance costs. And it's just, what was the discount rate given? And they give us 8%. That's why we use 1.08. So that's 8% times 4,286. What would that give us?
343.
343. So what's the addition?
4629.
Okay. 4,629. So that means we will have a deferred consideration here of 4,629. So before you sum it together, these finance costs needs to be recognized to POL of the parent. So you need to bring finance costs here. from 7. I think it's 343, right? Yeah.
Yes, sir.
So
Yes, sir.
let me add 343 to 21,800. That'll be
22,143.
okay. 22,143. Twenty-two 143. So just add 343 to this 61,500. 61,500. That'll be 61,843 or so. Abi?
Yes, sir.
We had,
Yes, sir.
we had 61,843 to 85, then to 4629. Then that'll give us how much?
74,972.
That was my total equity and liabilities. 74
972.
972. So why are we having 74,186 here?
I think that finance cost, is it supposed to be added to the retaining or subtracted?
Supposed to be subtracted
It's added.
as an expense. Okay, let's subtract it.
Mm.
Um, 21,457.
800.
21,457. That's 21,457. This is 61,157 plus 85 plus 4629. How much do you have? 74,286. We still
Maybe
haven't
it's
had.
due to approximation
No.
because we are approximating this thing.
It's more than
No.
approximate.
No. We didn't add. We must have added something wrongly when we're adding together. We didn't add something the right way. Can you add this again? This your that 100 naira is not approximation, it's addition error.
It's correct. 74,186.
Okay, and this one,
Okay, hold on. Can you move your cursor a bit from the last? Okay. So that's 61,157. That's correct. 74,286. So
can you hear me out this one again?
2,500. Wait, are we subtracting 20 from it from 28,286, right?
Yes.
That's 7,786. That's correct.
Oh, why is not the 100 naira? It's not approximation, it's costing.
15,000 plus 3,000. No, okay, wait, hold up. This 13,000 plus 8,800 minus 343. Okay, that's 1,457.
Anyway, don't let us waste our time on that. When you're doing your revision, maybe you would find it. I'm sure it will be a casting error issue. Can you confirm this one again, please? This 1.08 raised to power minus 2.
Is that in times raised to power 2 or okay, raised
Raised
to
to
power
power minus
minus
2.
2 times 5,000? That's
4286.
4,286. Yes.
Okay, and we have
Supposed to be 4,286.
1926 here. So, and we already did this one very well.
Let's confirm 8% of 4,286. Okay. And that one is 343.
So, when you're doing your own revision, you might find it.
Sorry, scroll up to where you have 4,286 minus 343. Not there. I think it's still can scroll up small.
So, okay, so in this question now, there are a lot of things here that this question introduced for us. Number one is we had to compute the percentage acquired ourselves. Number two, it helped us revise this deferred consideration, which we had to discount to present value. Number three, introduced an internally generated brand name for a subsidiary, which we had to then incorporate in the books of the subsidiary, which is this 25 as given in the question. The question actually gave us this 2,500. Also, and that was it. So every other thing is just as it is. So usually when you do this deferred consideration and you get your 4286, so immediately just come and do at the year end so that you will not forget it. Because what goes to the book at the year end is after you have unwind the discount. So by adding this 343, and don't forget that this 343, you're also going to remove it from the subsidiaries, from the parent's profits. You're going to remove it from the parent's profit. And that's it. And that's really everything. Then every other thing you just add together, you consolidate to give you what you're looking for. Okay, what's our time? Our time is almost up. So, and it continues like that. Now, there are just three things that is left that you will see in other questions. Number one is you will now be seeing a situation whereby the parents and the subsidiary consummated transactions and they are now making profit from one another. That profit should be cancelled out. That's all you do to it. You cancel it out. Whatever they have sold among themselves and they make profits, cancel it out. So that sales themselves, if there is receivables, payables arising from it, cancel it out. Cancel out. Now, but there is a particular one relating to, there's a particular one relating to, non-current assets. That one just requires a little application in the sense that if they sell assets, non-current assets to one another, and they make profit, cancel it out. The thing now is that the guy that bought the asset, the guy that bought the asset, he bought the asset at a profit loading, and that profit we are saying, as far as the group is concerned, it is unrealized. It is an intra-group profit that should be cancelled out. That therefore means that that guy might have been overcharging depreciation because he will have recognized depreciation on the higher value of that asset. So that you need to identify that excess depreciation and also eliminate, you reverse it. You have to reverse that excess depreciation that must have been charged. You reverse that one. Since you are saying the profits is unrealized, that means whatever excess depreciation you must have charged as well should also be removed. And by the time you are done with that, then I'll probably look at some other things. These ones are just application, and I've looked at this one before. We'll just look at it again. Then we'll solve past questions together. So by the time we solve past questions together, if I can solve one or two for you, then maybe you'll be able to solve few ones yourself as well. But this one would have exposed you to everything relating to statement of financial position. Then I will move to associates. Before associates, we should be done with that within a day or two, within a period. Then P&L as well. We should be done with P&L also within a period as well. Then that will be the end of group accounts. Then you can then start solving past questions as you wish. So I wouldn't want to waste too much time on this topic because these are fourth class. Yes, these are fourth class. So, and we are supposed to usually 6 classes to sort all of this. So we need to find a way to finish up as fast as possible so that we can move to ratios and EPS, which are like our final topics. We're already rounding up. And we still have statement of cash flows as well that we also need to actually tackle. Okay, so I think I can stop here for tonight so that you guys can get ready for your work tomorrow. Do we have any questions? Okay, so let me share your working notes, then I'll see you guys tomorrow. Bye.
Thank you, sir.
You're welcome.